In today's video, we're going to talk about a Wall Street bets favorite, a FinTwit darling, a name that has helped countless people get out of bankruptcy, buy that new Ferrari, that new Lamborghini, and buy the mansion with 500 pies that they've always wanted to bang. I'm talking about GameStop, the most degenerate stop on Wall Street. And how did this move happen? How did fortunes get made and millions went broke? Well, let's talk about the Parabolic move in game junk. Now, I don't know about you, but every video game I've bought online through PlayStation and Xbox has been downloaded. Just like if you were to get the new movie, you're sitting there late at night with a fine honey and you say, hey, let's put on a scary movie. You go to your smart TV, you download it, you buy it right there. You don't have to go to Blockbuster. Does Blockbuster even exist? No. But GameStop, it's kind of like a Blockbuster. It has used video games, which I guess people buy for $10 who are broke. Why don't you trade options so you don't be broke? Or you can buy Pokemon, Dragon Ball, or Funko bobbleheads of your favorite Star Wars character there, I guess. So I don't know about you, but GameStop is dead. But the stock went up massively. The market cap shot up. Billions. All in the same time period. So what caused a massive gamma squeeze, the massive short squeeze in GameStop? Well, let's look at it here on the daily. And the first thing I want you to realize is implied volatility exploding. Implied volatility. What is it? Well, as a stock goes up parabolically we'll say, or down, crashing, implied volatility rises because the price of the options become more expensive. Think of it as a stock reporting earnings tomorrow or the following day. The market makers are going to price the calls and the puts expensive because of earnings are an unknown event. Anything can happen. Stocks that have high implied volatility are stocks that usually move, like Netflix, Nvidia, AMD, Micron, kind of those crazy stocks out there, Tesla, that are very volatile, that usually move, 3, 4, 5+% a day. Well, GameStop here, the options soared in value. The call options, I should say, but implied volatility soared in value because of the crazy move. So how did this all start? Well, Citron Research came out around January 19th or so that week, and they said, hey, GameStop is going back to 20 a share. It's overvalued. We'll post a short report, blah, blah, blah. They basically said the stock was going to get cut in half. Now, Citron Research and short sellers, I don't know them, but I personally like these guys and girls. Because anyone who's been in the game 17 plus years in the craziest bull market, who's a short seller who survived, you got to give them props. And they do have good reports on some stocks and some don't work out. But timing in the market is everything, and timing is the hardest thing because none of us have a crystal ball, no matter how awesome you may think we trade and have hindsight. For example, if you look at everyone on CNBC, all they do is buy, buy, buy. They can't time the market. Imagine trying to time an individual stock. That's very crazy. That's kind of their job, and it's very hard. So Citron comes out, and they trade some size. I want to be clear on that. And they say GameStop's going to go back down to 20 a share, and then they say we'll have a full video live streaming it tomorrow. Well, on Monday, we had the inauguration of Biden, so they delayed it, and they kept delaying it from their Twitter. What they'll usually do is go on CNBC. They'll say, hey, we got a new short report coming up, and go on CNBC, and usually right before that, they'll have tons of puts. I can assume it's probably them buying the puts, but I never know. I'll see a ton of put orders come in, $1 million bets. Then they'll go on a stock and then say, hey, this stock's overvalued, and the stock crashes, and they make millions of dollars on the puts. That's what usually happens. So this time, again, same thing. Big GameStop puts rolling in. Boom, boom, boom. Hundreds of thousands. $1 million order rolling in the tape. And they get hacked. Their live stream got hacked and they couldn't finish. So therefore, their whole short report, they couldn't get out. So that caused the longs out there, and maybe your Wall Street bet friends out there, to say, screw this. This guy's a nut. We're going to take this stock higher and squeeze his ass because we know he's short the stock. So the puts that they buy, they're getting crushed in value. So that extra leverage. The stock that they're short, they're forcing them to cover. Think of it as you buy a stock at 100 a share, and then you wake up 2 days later and that stock is now 10 bucks a share. You're saying, shit, where did my $90 go? How did I lose it? I'm going to sell because I still want my $10 left. I don't want to lose everything. And lastly, the market makers and the people who are short call options, well, that caused the gamma squeeze. And what I want to do is look back here last week at the options, and we can actually go to that if we think back here on TD Ameritrade, Think or Swim. We could go back to the January 22nd options here. This is the option chain. And the max strike for the call options was $60 here, okay? Now, these call options the day before, so they were 60 bucks, or the 60 strike call options here. That was the max strike that was included. Now, if we go back here the previous day, those 60 strike calls were printing around 8 cents. That's $8 per contract here. Then the following day, as the stock jumped $20, the following day, those call options were around $5 or $500. So basically, think of it as this. If you sold those options for $8, those market makers, and then the next day they have to buy them back here at $5, that's $500, that's a big ass jump, right? That's huge. So they sold those options. So what do they do when they sell the options to hedge? They usually buy stock. Okay? So when you're short calls, usually market makers will hedge their short calls by buying stock. Well, as GameStop rolled through 60 a share, now the max strike, they can't sell any more strikes up. Normally what they'll do is they'll roll and sell a higher price. So usually they would go and sell the 70 strikes. And they'll just say to themselves, well, we're fine as long as the stock stays below 70 a share, right? You sell calls, you want the options, you want the stock to trade lower from the strike that you sold, and you collect that full premium. Well, they couldn't. There was no more strikes for them to sell. So therefore, they're having to buy back the stock. And as they buy back the stock here, and look how many traded, 238,000 of those Jan 22 60 strike calls. As they buy back the stock, it's not like you and me pressing the buy button here. No, they're forced to buy the stock. What I mean by that is when they are forced to buy the stock, when anyone is forced to buy the stock, when the brokers call them, whoever it may be, they get margin called, they're not saying, hey, Jim, yeah, you can buy back the stock at 42.78. We'll wait for it to get there. They say, you're going to buy back the stock at 43. If it's at 44, you're going to buy it at 44. And they drive the price up. As more people get margin called or have to cover their short calls, just like margin call if you're long stock, think of it that way, except in this instance, it's short stock. Now they have to buy the stock. And that caused an intraday move on GameStop where volume is picking up. You see how volume picks up as the shares go up? From about 50 bucks to 70 bucks. That is forced liquidation. There's no other way around it. It's not people buying it. They're forced liquidating. And that's when you have volume surge too. Eventually, as they can no longer take the pain and now the stock's at 70 bucks, everyone's gone. Boom. Those shorts got squeezed. They have to cover. They're either now, their account's blown up, their margin called, whatever it may be. And that's why you see the stock pull back. It's not that people are selling technically. It's just volume's drying out, and now the market makers, they're okay. Well, today GameStop opened up around $125 pre-market and opened up here around, I believe, around 90 bucks or so a share. And what happened? The people who were from still last week, either short stock who didn't cover yet, trust me, they're covering now as the stock was 90 bucks. And that caused another parabolic move where the stock traded all the way up to $159. You had multiple circuit breaker halts and everything like that in the name. And now you really start to see the stock unwind as we can see volume dry off here and as the stock goes sideways and implied volatility start coming out the options. So if you want to trade GameStop right now, well, guess what? The call options are priced out the ass. I mean, look at those calls. The 150 strike calls, so you see how they added more strikes now, they're $5.35. So basically, the stock's going to have to double for those call options to go in the money. The put options, if you're saying, Lance, this stock's going back down, I'm going to make a ton of money. Well, the 55 strike puts are around $7. So have fun buying super expensive options because implied volatility, the market makers are not going to get their ass kicked anymore. So even if the stock goes down, let's say to $60 this week, which is about a $16 drop, those 55 puts that you spent $7 on or $700 per contract, those bad boys are going to zero. That's right, even though the stock moves lower. So the options are expensive. I personally think the move in GameStop is over. I have no idea where the stock's going to go, but everyone who was margin called, who got squeezed out the ass, who was short, they're gone. There's no more players in the game now. It's probably just going to fizzle out. And we saw that same gamma squeeze with multiple stocks today and from Friday's session like Bed Bath & Beyond, where the stock was up to 47, now to 37. It happened in just about every high flyer, high short interest stock like AMC, like BlackBerry, that have a relatively very high short interest. The market maker said, hey, this is not going to happen again. For the call options, we're going to jack up the price of implied volatility. We're going to buy back stock to cover our ass. And that's what we saw today during the trading session, hence why multiple halts in stocks. Gang, this is something you usually see once every year, once every couple years. We saw it in Tilray just a few years ago. It is quite entertaining, but don't be a degenerate and put a lot of money into these stocks, whether you're long or short or plain. This is just the casino stuff right here. And this is why your FinTwit, your Wall Street Bet people out there, are doing so much commentary on it and such. There's so many good stocks that are moving with so many opportunities to make money right now in the market. You shouldn't be looking at this shit. I mean, pardon my language, but you shouldn't. You should not be looking at picking a direction and closing your eyes, spinning around, pinning the tail on the donkey of where GameStop's going to go next. Like, subscribe, leave a comment, and I am out of here because I'm hungry and I'm going to go grab me a big old beer.